Hello and welcome to this weekly market recap. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and it's a pleasure to join you again this week. I've got some interesting charts for you today, and thought maybe we'd take a look at it as many of the major indices are up at or near all-time highs. We do have a pretty difficult week ahead. Next week is historically the worst week of the year. That dates back to 1950 on the S&P 500, so we do have to pay attention to that. We've got options expiring later this week on Friday, so that too could throw a little monkey wrench into what's going on and the strength that we've seen, at least maybe in the short term. But once we get to the end of next week, we're actually going to start the best historical period of the year. If you go back and look last year in 2023, the stock market had a complete about face on I believe it was October 27th at the close. We woke up on October 28th and all of a sudden the correction ended and the market took off. And that is the date when the most bullish period begins. It's from October 27th close through January 18th close on the S&P 500. That period has ended higher than it began 63 times in the last 74 years. So pretty bullish period upcoming. Like I said, we have to kind of work our way through this next week or so. But then, technically, I think the market looks pretty good. Most of my signals continue to point bullishly, and we will also get those historical tailwinds to join us starting next week as well. But let's take a look at what happened over the course of the last week. So I like to bring this chart up. This is the chart showing a 1 week return on our 11 sectors and also our 6 major indices, just so that we can kind of look to see which areas of the market have worked and are working and which areas are not. If you look, first of all, financials, as I've talked about plenty of times recently, financials love Q4 and they're leading. Well, they've led over the last week, but they've been leading for quite a while. Financials still look very good. Banks just broke out. A number of the areas, actually, if you look at just about any industry group chart within the financials, you're going to see a pretty strong chart. So financials continuing to lead the way here. Utilities have certainly been bolstered, I guess, a little bit by the rates. Interest rates remaining somewhat lower. That makes their dividends look more appealing to income investors. So utilities have done well. Small caps, the IWM, finally, after challenging 224.70 up to around 225, that price resistance has been really challenging throughout 2024. We just made a close yesterday above that 225 level, clearing it. I'm going to talk about that a little bit further in just a bit, but those were some of the areas leading. But if you look at it, you've got small caps, you've got value-oriented stocks, you've got defensive areas, utilities and real estate. Also transports, finally, kind of like the IWM, finally making a breakout. I'll give you a couple of charts there to take a look at. Very, very important to see what the transports are doing and what some of those implications could be for the market in Q4 as a result. Down toward the bottom, you can see technology not too far from the bottom. We've seen a gain over the last week, but it's been fractional, definitely muted. NASDAQ 100 barely up over the course of the last week. Healthcare and energy down at the bottom. I'm going to talk a little bit about energy here in just a minute. Looking, at some of the other aggressive areas of the market, you can see that the XLY, consumer discretionary, not doing a whole lot better than technology. And then you had communication services. So if you're wondering why the NASDAQ was underperforming, it's mostly because many of the growth areas, the growth sectors, aggressive growth sectors, just didn't keep up pace with the S&P 500 and with some of the areas I talked about earlier, the small caps, the transports, the financials, and many of the value-oriented areas of the market. Keep moving and take a look first at the transports. So here was the sideways action that I've been talking about. And look at what just happened on Wednesday at the close. We went up and we actually made a close. Volume picked up and we were able to clear all of these prior highs. Now we're pulling back today. We have moved back up off the low. I'd like to see it hold and continue moving higher. But one thing that I've noticed in the market over the years is that I used to approach the market and say, okay, if we get a breakout, I want to hold that breakout level on a pullback. Well, I learned over time that a lot of times we would break below the breakout level, but hold the rising 20-day moving average. Because when you get a breakout, I start thinking uptrend. Well, where's your major support in an uptrend? Normally the 20-period EMA. So in this case, with the transports breaking out, we have seen a pullback. I'm really going to be watching closely the rising 20-day EMA. I suspect that holds as we go forward, but that's one thing to certainly keep an eye on as we move forward. All right, I want to show you another transport chart, and this is important because the S&P 500 tends to get a cue from transports. These red circles right here are showing that the S&P 500 really hasn't done much during these various periods. And actually, I could probably, let's annotate because I could draw one more red circle too. Right here, we're just going to move this right over into here. Because again, you can see that the S&P 500 really didn't do much in this period. Each one of these red circles or ovals coincide with transports not doing well. You can see the red dotted lines here. They're all downtrending, just showing that transports were not performing well. And as a result, the S&P 500 didn't perform well. But look at these blue directional lines. When we do get breakouts in transports and they are trending higher, look at what happens to the S&P 500. Now, this is going back over the last 15 years. But in 2009, when transports were on a roll, S&P here went up 95%. Transports on a roll, S&P up 48%. Transports on a roll, S&P up 34%. Transports on a roll, we gain 106%. We just made a short-term breakout. Now, if the transports can get up, if the dollar TRAN can get back up through 17,000, we made the 2024 breakout, but we still have got to get through 17,000. If that level goes, I think that what you're seeing already, which is a big move in the S&P, I mean, really from this low right here, transports have started to move back up, and you can see the S&P has done well while that's been taking place. But I think a bigger number would be that 17,000 level. If we clear that, that should, based on this history, 15 years worth, result in strengthening of the S&P 500. I know we're already at all-time highs, but I believe transports break out. That's going to be a catalyst for the S&P 500 moving through that 6,000 level. All right, another chart I wanted to show you from last week, crude oil. So crude oil, if you look at the chart, this is just a chart of crude oil going back the last 5 years, actually last 3 years. And then down below here, we've got how the XLE performs relative to the S&P 500. And for the most part, when crude oil goes up, energy outperforms. When crude oil is coming down, energy underperforms. And you can kind of see that relationship all the way. Makes common sense. I mean, crude oil prices are going down. It's going to make it more difficult for energy companies to make money. When crude oil prices are going up, the opposite. They should be able to make money with rising crude. Now, there was one period back here I just wanted to highlight because this was kind of unusual. In 2022, we had crude oil prices going down and yet energy was outperforming. But that's the exception to the rule. Check out in the middle. This is the correlation that tells us the relationship between the cost of crude and the relative strength of energy versus the S&P 500. And that blue shaded area tells us when it's very, very positive, when that correlation is very positive and the two are going hand in hand. The red shaded area is when they are going opposite one another. And you can see clearly that we stay mostly in the positive correlation. So I pointed out because we've got major crude oil support down at about $65 a barrel. And we've hit this now 4 times over the last 3 years, every time bouncing. We're back on the move lower in crude oil again. We're back down around $70 a barrel. If we were to get to 65, I just want to point out that might be an opportunity to take a shot with energy, maybe to overweight energy. And if crude oil doesn't hold 65, I would be out of energy, would be taking no chances with the group. Also wanted to mention that their seasonality, the energy seasonality tends to be weak. So I pull up that seasonality here. You can see the XLE relative performance versus the S&P 500 during the current secular bull market. So since 2013, energy relative to the S&P, you can see that the chances of energy outperforming go down quite a bit in October and especially November. And so the weakness we're seeing right now and the weakness we may see in November is that's historically what we've seen. So just be careful. Crude oil goes down to 65. You might take a chance, but if it doesn't hold, you're going to want to be out. And I think the seasonality also suggests that as well. All right, 10-year Treasury yield. This is a short-term kind of correlation I wanted to point out, because recently what's been happening is that as the 10-year Treasury yield goes up, small caps, the IWM, relative to the QQQ, which tracks the NASDAQ 100, they've been moving opposite one another. So when the rates have been going up, when the 10-year Treasury yield has been going up, IWM has been underperforming. But when the 10-year Treasury yield rolls over and starts to go lower, IWM has been outperforming. Right now, we're seeing this 10-year Treasury yield jump back up again today. It kind of hit a bottom middle part of yesterday. And you can see from that moment, the IWM has been underperforming again. And we're seeing the 10-year Treasury yield moving back up. So if the yield were to break out, and I think 415 is really a big level to watch, if the yield breaks out, there's a reasonable chance that the IWM is not going to be able to hold on to support. Or at least if it does, it's probably still underperforming the QQQ, which may be going much faster. Anyway, just wanted to point that relationship out. Down here is another correlation where you can kind of see it on the correlation. Here's positive correlation, which is barely even reached. And then down at the bottom here is an inverse or negative correlation, showing that the two are going opposite. And you can clearly see that's where we are currently. We're down near that -1 level. Okay, so if we take a look at the IWM standalone, you can see that we made this breakout with a rising lows, a little bit like an ascending triangle, but it really doesn't come right after an uptrend. So I don't know how much I would use this as a measurement, but it's still important to get the breakout of equal tops like this coming across. So what I would be looking for now is, number one, do we hold this 224.75 to 225 level? That's what I'd look for first. So far, we're trying to do that today. If we did fall back below, say 224.50 and close there, then I would be looking more at a possible 20-day test. But right now, I think the IWM looks really good. It is definitely pausing today. I don't expect the 10-year Treasury yield to keep going up, which makes me believe that this pullback is viable on the IWM. But I would watch those two key support levels. All right. I do want to mention, first of all, that if you go over to our website, you can sign up for our EB Digest. It's a free newsletter. You simply scroll down. Again, go over to our website. It's EarningsBeats.com, both plural, EarningsBeats.com. You can scroll down. We have a free newsletter. Name and email address is all it takes. It gets delivered Mondays and Wednesday mornings. There's no credit card required. You can unsubscribe at any time. It's really just an opportunity for us to give back to the community. So we'd love to have you join that. Also, we're having a big quarterly draft tonight for our model ETF portfolio. This is a portfolio that has outperformed the S&P 500 more often than it hasn't. And what I'm going to be doing is going through and talking about the themes, why I'm putting different ETFs in, talk about the ETFs themselves, and I'll also highlight one of our really cool tools at EarningsBeats. It's called our ETF Analyzer, which I will describe during the seminar as well later this afternoon. It's going to start at 5:30. You do need to be a member, but you can be a trial member. So simply clicking on that Join Now, you can go through. You do have to give credit card, but it's a 30-day free trial, and we will remind you before the 30 days is up. But be sure to check that out. If you are on a mobile device, you can just scan the QR code that's on your screen now. It'll link you over to the page where you can sign up for the EB Digest. So just link you over to our EB Digest page. Anyhow, let's get back to the market. Still got a few things I'd really like to talk about, and I want to go into some individual stocks here. So these are stocks that have been great performers in the past, leaders in the market, most of them, and they're on the verge, or they've either broken out or on the verge of breaking out. And I think these are stocks that you want to keep on your watch list. Obviously, the first one is Nvidia. Nvidia right now is trading back above 140. We have never had a close on Nvidia above 140. So it is challenging a major breakout today. Watch this closely, because if Nvidia breaks out, I think it'll be very bullish, not only for Nvidia, but for the semiconductors, for the XLK, which is technology, and also for the QQQ, or the NASDAQ 100. This is one of your leaders. It's looking to break out. AI is definitely starting to get much more interest again, and this breakout would be a very significant breakout in that area. Next up, Apple. Apple also up near its high. You can see it reached the high in July, came all the way back, failed just a couple of days ago, back on Tuesday. And now here we are, just a buck or two away from breaking out on Apple. Third stock, Autodesk. Autodesk already had a triple top breakout just about a week and a half ago. Huge move to the upside. Look at the AD line turning up. Relative strength, very, very strong. Software still weak, but here's one of your leaders. So definitely keep an eye on Autodesk. Any kind of a pullback to the rising 20-day moving average would be viable for me. Trade Desk, AD line strong. Price continues to trend higher. Again, this is in the software area. It's another one of those really strong software stocks that you should keep an eye on. Next up, Palo Alto Networks, AD line strong. You can see the top that we hit all the way back here in February. We got close in August, couldn't get through. Here we are again. We're right on the verge of a breakout. These are stocks you absolutely want to keep an eye on, because when they break out, they tend to lead. These are stocks that you want to consider owning on breakouts. Booking Holdings just broke out. BKNG. AD line strong, relative strength near 52-week high. Just recently got this breakout. I think Booking looks to go higher. DoorDash. DoorDash had a couple of key resistance levels. One from back in March when it got up to about 142.5. Another just about 3 weeks ago when we broke up to got up to 145. So that area should hold as support. Notice the rising 20-day moving average right in there as well. It is a leader. It's got strong AD line, and as a result, this one on any pullback looks solid to me as well. Cintas Corp, double top. Looks a little bit like an ascending triangle, just made the breakout. Another one that on a pullback looks good. You can see again, AD line strong. Relative strength had pulled back during the consolidation, but starting to pick back up again now that we've had the breakout. FTNT, this is Fortinet, AD line very strong. Relative strength just hit a 52-week high. Huge breakout. Stock is pulling back today, actually getting close to this 20-day moving average. I think down to $78 looks like pretty good entry. Next up, PayPal. Haven't talked about PayPal being bullish in a long time, but PayPal actually looks really bullish right now. AD line starting to turn up. We trended up off of the July low. We've taken out a couple of key areas. We gapped above resistance that was set back in late August, early September. And that gap support line right now comes in at 75. And you've got price support comes in around 74, which is that 50-day moving average. I think in the short term, we see that rising 20-day moving average as support, but maybe somewhere down the road, we get a little bit more weakness on PayPal. That's where I think 75 could come into play. But I do like PayPal. I like what's going on there. So that is it. That's what I have for today. I do have a screen up now, though, or a slide where you can, again, scan your QR code, and that will take you to a landing page where you can follow what we do at EarningsBeats and where I post and the videos and everything else. So be sure to check that out. Love to have you follow me. And be sure to like the video here at Stockcharts. Subscribe to the Stockcharts channel. You get great information, hopefully not only from me, but also from a lot of other contributors at Stockcharts. So again, it's been a great pleasure being with you again this week. I'll be back next week. We'll check it all out. Let's see if the upcoming bearish week holds true. It's the worst week of the year. Do we go back down at least temporarily? We're going to find out next week. Have a great week, everybody. Enjoy the rest of your week and weekend, and I'll see you next Thursday. Happy trading.